Welcome to the final of those videos relating to the analysis of corporate credit risk. We're going to tackle a couple of topics, sundry topics, which remain towards the end of the reading, namely seniority rankings, recovery rates, and credit ratings as they are applied to issuers as well as individual issues. Okay. Starting off with, at the top, with seniority rankings. What this is basically the way in which we establish the priority of payments to the various debt holders. Who gets money first, who gets money later, and of course holding a bond which entitles you to receive money in case of default earlier than others or later than others will have an impact on the value of that claim. It will have an impact on the value of the bond. Now I've been throwing around words like senior, junior, secured, unsecured, subordinated, unsubordinated, etc. So now is the time to put all of this in place, sort of in perspective, properly. That's what we mean by the ranking. Let's begin with the highest seniority ranking. So highest seniority, this will be associated with what we call the first line or mortgage, first mortgage. Now it's also possible to have second line or second mortgage, and we'll talk about this in a moment. The next one is in order, is what we call senior secured. So senior secured debt, and followed by junior secured. And these three phrases or these three rankings, they all relate to secured debt. Now secured debt will be associated with lower levels of loss given default. Right, so what I mean by this is if default happens because the loan or the claim is secured on some specific asset, let's actually write this down. The lender or the debt holder has a direct claim on specific assets or a specific asset, and the cash flows that may arise or will arise from its sale if that asset gets sold following a borrower's default. So obviously, if default happens, you're going to incur a lower cost or lower loss if you hold secured debt instruments. However, the fact that a bond is secured doesn't really impact that much its probability of default, because as you'll see later on, probability of default is relatively constant across different issues, mainly due to or partially due to cross-default clauses, which we'll talk about. Right, that's highest seniority. Now let's move on to some of the unsecured ratings or rankings, starting with what we call senior unsecured. Okay, that's the top of those unsecured ones. Then senior subordinated. And then just subordinated, finishing with junior subordinated. Okay, subordinated meaning, below everything else. Right, these of course are examples of unsecured debt rankings. This will come with a higher loss given default, and the idea is that obviously you generally should be paid off using the operating cash flows of the business, but if those don't suffice, there is no specific claim on a specific asset directly. You have a claim on kind of the residual net assets of the business following the satisfaction of the claims of the more senior holders of debt. So the lender in this case has what your curriculum describes as a more general claim on the assets of the borrower and the cash flows from their sale. Of course, those who are secured on specific assets, they come first. Okay, right, so highest seniority was up here. This, of course, is the lowest seniority level. And that's the spectrum within which we will be holding the discussion for the next couple of minutes, because there is more to say on this. Let me start off at the very top, first line or mortgage. What does that actually imply? It's not a name that we've been sort of mentioning much at all. So first line and first mortgage. I guess that for those of you who are not native English speakers, and I definitely am not, especially this word line may be confusing. Right, first mortgage, that means the lender has designated and has pledged officially, legally, a specific property to act as the collateral, the security on a loan or on some kind of debt, pledge of specific property. First line is very similar, except it doesn't have to be a property. So this is the pledge of assets, specific assets. They could be buildings. Yes, but they don't have to be buildings. They can be other items of property, plant and equipment, so machinery, for example. They could be something intangible, like trademarks or licenses. They could be an item of current assets, like inventory, so you can establish a line on pretty much anything that is an asset, but you can only establish a mortgage on or pledge under a mortgage agreement only an item of property. Now, the word first here indicates that you are first in line as a lender to get your claim paid, your debt paid back, using the cash flows from the sale of that asset. But somebody could be written in there under the second line, so you can have a second line or indeed a second mortgage, right? So second line secured debt is generally thought of as being the same as senior secured. So you are senior secured. You're not as well secured as the people who have the first line or the first mortgage, but this is generally thought of as being the same thing typically. Right. Your interest is secured on the pledged assets, but you rank below the first line obligations. Good. Then we've got junior secured, and we move on to the unsecured rankings. Let's just state that this one, senior unsecured, this is the most common of all corporate bond types. So this is the most common corporate bond type. Many high-quality investment-grade issuers primarily issue senior unsecured debt. They're in such a good situation that investors do not necessarily look for secured bonds, so they can issue senior unsecured. And let me just say that for the lowest ones over here, like subordinated, sorry, this should be subordinated or junior subordinated, this really is, the lowest priority and often associated with absolutely no perspective of recovery in case of default. So the chances that you'll get anything back if the company defaults and is unable to make cash flow payments or the debt payments, debt services payments is very remote. So that would mean your loss given default is practically 100%, right, in case of default. Right, let me also say that many issuers issue debt across the whole spectrum, maybe not the whole, but across the different rankings, to kind of fine-tune it to what investors want to buy, what level of protection they are looking for, and that ultimately results in an optimization of the cost of capital at which money is borrowed by these issuers. And one more important point. Right, over here I've got senior secured. Good. So let's imagine that the collateral, so if collateral for a senior secured bond, the value of that collateral falls short of the value of the debt or the loan, right? In other words, the collateral proves not to be worth enough to cover, after its sale, the whole amount which we owe as borrowers to our senior secured holders of debt. Whatever proves to be the shortfall doesn't automatically, I don't know, become junior secured or something like that. No, it becomes senior unsecured. So over here, shortfall transitions or becomes senior unsecured debt, simply to be satisfied out of whatever is left once the secured assets that were pledged as collateral have been sold off. Now, the next point in our discussion is going to be around recovery rates. So, how much one can recover if default does indeed happen. Let me make a general comment which your curriculum is quite insistent on. Debt holders of the same seniority level, for example, senior unsecured, are treated the same. So it doesn't matter which issue of bonds they hold, right? They are treated the same. This is absolutely irrespective of the actual maturity date of the debt which they hold. So if somebody holds debt which still has 20 years to maturity and somebody else holds debt which only has 3 years to maturity, that maturity date doesn't matter. If default happens and they rank the same in terms of seniority, for example, senior unsecured, they will be treated the same, which actually implies that they get, being treated the same means they get the same pro rata share of any cash flows that result from the sale of the residual assets. So maybe not get, but they have the same pro rata, meaning proportionate to the size of their to their loans, claim in case of bankruptcy. Okay, now some additional, I guess, important points on recovery rates. Recovery rates, which your curriculum sort of pushes across and emphasizes. First of all, recovery rates hugely vary across industries, so they vary by industry. And your book talks about them being especially low in those industries which are in what they describe as secular decline. Industries in secular decline will have definitely lower recovery rates. What do we mean by secular decline? Well, industries may be in cyclical decline, which is part of the normal cycle, economic cycle, and credit cycle as well, which means it's only temporary. Sometime later they bounce back. Secular decline means it's a diminishing industry, kind of irrespective of what phase of the cycle we are in. And the lower recovery rates associated with these industries, I guess, are going to be a function of the fact that if we try to sell the assets of businesses belonging to these industries, there may not be many buyers willing to buy the machinery, equipment, etc., because the industry is in decline. Now, recovery rates will, of course, be higher in those industries or for industries which are only experiencing cyclical downturns, experiencing cyclical economic downturn. And I guess that should be quite obvious, right, for everybody, instead of secular. And another point, recovery rates also vary based on when they occur, or when default occurs, or bankruptcy occurs in the credit cycle, which is pretty much linked to the general economic cycle. So if a company defaults in an upward strong economy, okay, it's obviously possible that a company may be unlucky or may have made some huge mistakes and they go bust, they default. The recovery rates will be higher, typically because there will be a stronger market for the assets that now have to be sold. Demand for assets will be higher than in a case where a company defaults in a weak economy. Obviously, recovery rates are lower, seeing as there are not many willing buyers to buy the assets of failing businesses. And a more general comment on recovery rates. Recovery rates, remember, are, when you see them being quoted, for example, by rating agencies, they are averages. They are based on historical averages. And those averages come from different industries, across industries and companies. So please treat them as averages. They are not indicative of what you may experience if a specific borrower defaults on their debt. Right, some more comments on the process of bankruptcy, which is, at the heart of the discussion on recovery rates. So we typically assume that in the case of bankruptcy happening, there is a nice, tidy order in which people should be repaid. First, the senior or secured debt holders, followed by those who are not secured. So, lenders with higher ranking claims should be paid first. That's the general expectation. However, what you may encounter in practice is not necessarily this. Often, lower ranking lenders, as well as shareholders who, in theory, should be at the very end, even below the junior subordinated debt holders in terms of the hierarchy of receiving anything. Even the shareholders may recover some funds, even if the more senior ranking lenders, more senior debt holders have not been repaid fully. Let's see if this sentence makes sense. Lower-ranking lenders and shareholders may recover some funds, even though the more senior debt holders have not been repaid fully. Okay, it's a proper sentence. Now the question is why? Well, it's to do with accelerating the whole process. You see, bankruptcy doesn't just happen overnight. Bankruptcy is a process that takes time. So this is the bankruptcy process. And in the case of bigger businesses, this can take a long while, especially if you've got lots of different categories of financial claims, different categories of bonds, collateral, etc. And everything has to be sorted out. All the arguments have to be heard and given consideration. During that time, however, the legal and accounting fees mount up. What is more, critical employees of the company are fleeing elsewhere, so leave. Competitors gain market share. They woo your clients away, they snatch your clients away. And clients may want to leave a company which is in financial disarray, in financial distress. And all of this, lowers essentially the value of the business. So company value goes down. And you can say, well, what doesn't matter? Well, somebody may still want to buy that failing business to turn it around, and you want to sell a business that is as much, intact as possible, even though it's failed. That's critical from the point of view of extracting the most value for the debt holders and potentially the shareholders as well. Now, the longer the process drags on, the more of this drop or deterioration in corporate value will actually happen, more or less. So this provides an incentive for the more senior debt holders. So the senior debt holders have an incentive to actually accelerate these proceedings. And that means compromise and compensate the junior debt holders, as well as sometimes the shareholders as well, just to speed things up, to speed the process up, to prevent the drain of value or the deterioration of value. This is why or how sometimes in these more complicated cases you may see junior debt holders as well as the shareholders walking away with some value, even though in theory they shouldn't have been entitled to get this. And please also note that bankruptcy proceedings may vary greatly from country to country. So, for example, your curriculum states that in the US, the courts definitely push towards solutions where the company is reorganized and restructured, and we try to recover. So, towards reorganization and corporate recovery. So debt holders are incentivized, are asked to potentially restructure, agree to a restructuring of the debt, maybe lowering of par value, extension of maturity, just to keep the company going and give it another try. Whereas elsewhere, you will often see more commonly a liquidation being ordered. So we wind the company down and we sell the assets to satisfy the claims of the debt holders without asking them to give the company another go. So, you must be aware of the process and the practice in a specific jurisdiction. Good. Now, the final topic on this list was credit ratings, and we're going to talk about it now. However, the essence of it is that ratings come into forms. We're going to have the issuer rating and ratings provided for specific issues. So issue ratings meaning specific notes or specific bonds. So the issuer rating is an overall assessment of the issuer's naturally credit quality. And one thing to bear in mind is that it typically relates to what we would describe as senior unsecured debt. So without assuming that there is any security or collateral involved in the debt. Issue ratings, on the other hand, relate not generally to the issuer's credit quality, but they relate to the quality and the riskiness of a specific obligation. So they relate to specific obligations, actually to a specific obligation, a specific bond, taking into account its specific seniority rankings, as well as the collateral situation, etc. Taking into account its seniority and security, so the collateral. Now, something I said before, let me say it again properly now. The probability of default is more or less the same or similar for the issuer as such and specific issues, irrespective of their seniority ranking. And the reason is mainly because of something we call cross-default provisions. And we had an opportunity to mention this in a much earlier video on bond instrument features. A lot of bonds, or the majority of bonds, have a provision in them which states that if the issuer defaults on any obligation, any bond that they've got outstanding, or any debt that they've got outstanding, that automatically triggers a default on their other obligations as well. So even though you may be holding a bond on which nothing bad has happened yet, the fact that this issuer has encountered problems servicing their other debt, for example, not missing a coupon payment on a different bond, will trigger a default on your bond as well, with all of its consequences. So the probability of default across the different issues is pretty much uniform and in line with the probability of default of the issuer as such. But what is important is that the LGDs, the loss given default, will be different. And that's because each issue has its own specific seniority ranking, its, level of subordination, its level of collateral or specific collateral, which will make it unique. Now, let us now just list two considerations which are quite important, well, in the view of the curriculum authors to consider, and they will be the final two in this lesson. The first one is on something called structural subordination. Structural subordination is a term that relates to the relationship between a parent company, parent business, and its subsidiary or subsidiaries. You see, because they form a group of companies where the parent controls its subsidiaries, you may think, well, the parent can force the subsidiary to give it cash so that the parent can pay off its own debt. Well, structural subordination is all about appreciating the fact that the cash flows of a subsidiary, which in itself is a separate business, must be used to repay or to service its debt absolutely first. So if a subsidiary has debt outstanding, its cash, or the cash that it generates, must be used to service its own debt first, and only then can the remaining cash be passed on to the parent via some sort of scheme, so that the parent has cash flow, adequate cash flow to pay off its debt. So first, before the cash flows may be, I like this term, upstreamed. So transferred to the parent up in the grand scheme of things, upstreamed to the parent company, obviously to pay off the parent's debt, potentially to service the parent's debt. So please appreciate that even if you're buying the debt of a company that controls multiple subsidiary businesses, and you may think, oh, okay, its cash flow situation is pretty secure because it has all those smaller businesses or businesses below it that it controls, that there are limits to that control and the ability to force those other businesses to pass cash flows onto it or upstream those cash flows. And the second point, very different, is that there is a process called notching in providing ratings. And notching is, generally speaking, the process or the methodology used to adjust the ratings given to different issues, bond issues, notes issues, but from the same issuer. So an issuer will have its own rating, but then specific issues will be either rated better or lower, right? And that process is called notching, making these upward or downward adjustments. And as we said, the rating provided to the issuer themselves is typically based on the assumption typically of the ranking being senior unsecured. And your book makes, I think, an important point, which I want to clarify here. How much the notching process generates in terms of ratings, issue ratings being in fact higher or lower, really depends on where the issuer rating is itself. So if the issuer rating is pretty good, like AA, signaling a pretty low probability of default, the fact that you're going to have some bonds being secured, other bonds being from the same issuer unsecured, and the collateral being different here or subordinated, etc., will not matter so much because the probability of default is fairly remote. So the higher the issuer rating is, so the higher this is, the less notching required effectively, the less adjustment for specific issues required. However, if you've got an issuer who's rated, let's say, single B, which is relatively low, then notching will be very much required to show the difference between different levels of seniority rankings in the bonds and different types of collateral, or different assets being used as collateral. So for lower rated issuers, priority plays a big role, and therefore notching will be absolutely critical and will bring a lot of potential differences to how we view the bonds, given their different loss given default or recovery rates.